Hello, and welcome to the video lecture for Chapter 2. Chapter 2 is another foundational chapter for all of economics, and it focuses on the concepts of scarcity, trade-offs, and opportunity cost, which is a particular type of trade-off. So welcome. Let's go ahead and get started. Okay, so for this chapter, as a little food for thought, probably didn't know this, but for every missile that the U.S. Navy fires, it basically costs them over $1 million to fire that missile, between the cost of the missile itself and the fuel, as well as the personnel that have to take care of it, maintain it, get it ready to launch, and so on. Now, there's a good chance that the U.S. military's resources are unlikely to increase very much in the foreseeable future. And so one dilemma that the Navy faces is a trade-off between producing more weapons, more missiles, and replacing worn-out ships. It can't, if it does one, then it basically gives up the opportunity to do the other one. So if it builds more missiles, then it can't replace as many worn-out ships, and vice versa. If it decides to replace worn-out ships, it can't build as many missiles. Think about that as we go through this chapter. Put it in the back of your mind and sort of revisit it, and we'll think about it as we go through this chapter here. All right, so our learning objectives for this chapter. For section 1, we want to be able to understand why everybody, whether they're poor or affluent, rich, everybody faces this problem of scarcity. So we'll talk about what scarcity is and why everybody faces it, even rich people. And then we'll move on to section 2 and explain why this issue of scarcity causes or requires people to consider something called opportunity cost, as well as other trade-offs when they're deciding between alternatives and making a choice. Then in section 3, we'll talk about how when an individual or a firm, a business, or a government, when deciding to produce or consume more of one thing, it necessarily entails giving up something else, and giving up something else in increasing amounts. So the more, going back to our Navy example, the more ships it replaces, not only does it have to give up more missiles, but for each additional ship it replaces, it has to give up increasing amounts of missiles. So the number of missiles it has to give up increases the more it replaces worn-out ships. So we'll talk about that in detail. In section 4, we'll talk about why the economy faces a trade-off between consumption goods and capital goods. So we'll talk about what those are. We'll talk about what consumption goods are and what capital goods are, and why society faces a trade-off between these two types of goods. And then in section 5, we'll wrap up the chapter with a discussion of these concepts of absolute and comparative advantage, which relate to the model that we're building in this chapter. So basically what we're doing in this first chapter is actually building our first model. It's one of the most rudimentary, simple models in economics, and it will be the first model that we build. And we'll see it in just a second. All right, so there's the outline there. Scarcity, opportunity cost, trade-offs and choices, the economic choices a nation's people face, economic growth, production possibilities, and the trade-off between present and future. So that's the trade-off between consumption goods and capital goods. And then talking about comparative advantage, specialization, and trade. All right, so here's some more food for thought, maybe something that you weren't aware of, but over the past 40 years, the number of hours that the average employed U.S. resident works to earn income has increased by more than 10%, from right around 1,700 hours per year to almost 1,900 hours per year. So an increase of almost right around almost 200 hours per year additional. Um, Now, I want you to think about this choice within the context of this chapter as well. So, people are obviously choosing to work more hours on average. Think about the kinds of things that they have to give up in order to work those additional hours. That's essentially what we would consider to be leisure. So, this is really a labor choice. This would be a topic for labor economics. So if you ever go on to take a labor economics course, you would focus on this sort of decision in detail. But think about that as we go forward here. All right, so let's start off with defining scarcity. What is scarcity? So you've probably heard this term before, but let's make sure that we definitively know what it is. So this is one of the most basic concepts in all of economics. It really is the reason for the entire subject of economics. But scarcity occurs anytime the so-called ingredients for producing things that people desire are basically not sufficient to satisfy everybody's wants, right? We talked about what wants were in the last chapter, right? So recall that wants are anything you would buy if you had unlimited income, right? Those are considered your wants. Now, of course, we have limited income. We don't have unlimited income and resources. So we have to make choices. We can't have everything that we want, in other words. We can only have some things that we want. Other things we have to forego having. And so scarcity just means that we will never have enough of everything, including time, to satisfy our every desire or want. So this is inherently a fact of life. We have limited resources in all kinds of ways. We have limited time. We have limited energy. We have limited incomes and limited wealth. And this is true regardless of who you are, right? So even Bill Gates, right, one of the richest men in the world, faces the issue of scarcity. He only has so much time in a day. He only has so much life left to live. And, you know, even though he does have lots of money, it's not unlimited, right? It still is limited. It's not infinite. So regardless of whether you're poor or insanely wealthy, everybody faces this issue of scarcity. Now, we do have to be careful here. Don't confuse scarcity with a shortage. So if you're in micro, you will learn about what a shortage is. Scarcity is not a shortage. Scarcity is also not the same thing as poverty. As hopefully I made obvious with my example of Bill Gates, right? So even Bill Gates faces the issue of scarcity, so it's not the same thing as poverty either. So don't confuse scarcity with a shortage, and don't confuse it with poverty. They are not the same things. All right, so in order to continue on our way to building our first model, we need to understand a few other things. So one of those things is the definition of production. So production is just the activity of converting resources into products that can be used in consumption. So at the end of the day, what we're interested in is what we are able to consume, because we derive benefits from consumption as human beings. So, for example, let's see. I've got some paper here. I'm going to consume this paper in the course of teaching this lecture. So it's useful to me in that sense. Now, what are the resources that were required to make this paper? Of course, trees, lumber is where the raw materials came from. Um, of course, there was some labor involved. There were probably some other resources involved, like they had to bleach the paper probably to make it white. There were a number of machines involved in making this paper. I'm sure, from everything from the chainsaw used to cut down the trees, or whatever machine they used to cut down the trees. Then those trees had to be ground down into pulp. So there was certainly a machine that did that. A number of other machines involved in the whole process. So all of those things that were used to make this paper are the resources. Now, the resources aren't consumed. They are useful in producing something that is consumed, something like this paper. So, think about some things that are around you right now that you might be consuming, and think about the resources that had to be utilized to produce those things that you're consuming around you. Some synonyms for resources are factors of production. So the things that are used in production, in other words, factors of production. We will also call them inputs. So, in other words, inputs that are used to produce things that people want, right? So that's what resources are, and that's the nature of production. We can categorize resources into a few different subcategories. So land, it includes what we traditionally think of as land, right? Areas of earth, patches of dirt, if you will. But it also includes other things that come from nature, like lumber. So lumber would have been considered land in the paper example here. Other things that come from nature might be, coal, oil, right? Those are resources that would be considered land because they are natural resources or gifts of nature, okay? Another type of resource is labor, so those are human resources, right? So people working, of course, is labor. That's an additional resource, subcategory of resources. And then we have something called physical capital, which are manufactured resources. So these would be things like computers, machinery, warehouses, factories, let's see, what else? Cars, to some extent, if they're being used in production, right? Vehicles used in production, trucks, trains, all these types of things are physical capital. They're resources that are manufactured. So they're not like land, where oil and coal and trees aren't manufactured. They're kind of just gifts of earth, of nature. So this type of resource is manufactured. Now there's another type of capital called human capital. And this is, we separate it from labor because it's not the act of working, but it's the accumulated training and education of workers. So it's an intangible type of resource. It's in our brains, so to speak, and so we can't touch it. It's certainly not manufactured. It's not made in a factory or something like that. But it's basically the valuable resource of human knowledge, right? So that's called human capital. And then we also have entrepreneurship as a resource, and this is basically the activity of creating and maintaining businesses, right? So skills like raising capital, right? Bringing together physical capital and human capital, right? That's what we're talking about here when we talk about raising capital, finding those resources, bringing them together, and then also organizing, managing, and assembling other factors of production, including capital, so like labor, for example, or maybe land as well. Entrepreneurship also includes making basic business policy decisions, right? So hiring and firing protocols, best practices, safety procedures, all of these sorts of things would be considered business policy decisions. And then probably one of the most important aspects of entrepreneurship is taking on risk, because starting a business and making investments always involves some amount of risk, and that's part of being an entrepreneur. All right. So now to continue building our model, getting to a point where we can complete and build our model, our first model, we need to understand a few more things. So let's make sure we understand the definitions of goods and economic goods. So a plain old good is anything from which an individual derives satisfaction or happiness, what we will in micro ultimately call utility. Okay, so usefulness, in other words. So anything that people derive usefulness from, either in terms of satisfaction or happiness or some other form of usefulness. So that's what we would consider to be a good. A little bit more specific definition would be an economic good, and that's any scarce resource for which the quantity demanded exceeds the quantity supplied at a price of zero. So in other words, if it was free. Another way to think about this is that there would be a shortage for this good if it was free. So pretty much anything that has a positive price is also an economic good. Anything that has a positive price is considered to be an economic good. So I'll go ahead and draw you a picture of what that looks like here so we can understand it. This will be a little preview of our supply and demand model in chapter 3 that we'll see. Okay, so here's quantity, here's price. Let me switch over here so you can see this better. Okay, so here's our graph. We've got price and quantity on the axes here. Now this here would be a demand curve. We'll talk about this more in chapter 3. But this is a demand curve. It's downward sloping. And this is a supply curve. Let me go ahead and do this. Supply curve there. Extend this out down to here. Okay, so there we go. There's a supply and demand curve. Where is price zero? Well, it's right here. This is price zero, right? Because recall that from the appendix, the video on the appendix, our origin is where the two axes equals zero, so that's where zero price is. And you'll notice that at a zero price, here is the quantity supplied, right? So QS. And here is, at price zero, here's the quantity demanded, QD. And very obviously, as you can see, the quantity demanded is greater than the quantity supplied. So there is our economic good, right? But it also entails that there is an equilibrium, at least, a positive price. So P star means equilibrium price. This is really just a preview of chapter 3. So don't worry too much about this right now if you're not sure exactly what's going on in this picture, but this is what we will see and go over in detail in chapter 3. And this is what an economic good would look like in terms of supply and demand, and quantity supplied and quantity demanded. Okay. All right. Now, we can also talk about services, which are just a specific type of good or a specific type of economic good even. Services are basically intangible goods, so things that we can't touch, they are services. So things like haircuts, the service of getting a haircut, massages. Right now I'm providing a service. Education is a service. There's lots of examples of services. In fact, the services sector in the economy has been growing in the United States over the past several decades, and it now accounts for the majority of economic productivity as services. So again, it's just any task that can be performed for someone else. Tax services, getting a car wash, right? All these are examples of services. Now, recall that scarcity, again, is when the resources for producing things that people want are insufficient to satisfy all wants. And again, recall that we assume in economics that people have unlimited wants. There's no limit to what they want. So just recall that. Don't forget about it. Now, we're going to wrap up this section with a discussion of needs versus wants. So in economics, we can't really define what a need is. That doesn't mean that in normal language they don't exist, right? We can talk about needing water and food and shelter. But ultimately in economics we can't define that. We can only say that a person really, really badly wants water, or that they really, really badly want food. And obviously it's because they need those things to survive. But wants are anything, goods and services, on which we place a positive value, and therefore they typically have a positive price. There's a relationship there between value and price. They're not the same thing, but they're related. And again, we assume that people have unlimited wants, right? If we had unlimited income, right, I'd be flying to the moon and back if I could. That's something I would want to do. I would love to travel to other galaxies even. And if I had unlimited resource, feasibly I could do that. But even as of now, with all the resources on planet Earth, nobody's traveling to distant galaxies, at least as far as we know, right? All right, so that concludes section 1. I'll see you in the next video lecture for section 2.